Hi, everyone. Welcome this evening to our Money Matters series. We will be focusing on borrowing. Please come in and we will wait maybe a minute just to see who else joins us. But thank you so much for showing up this evening. All right. Maybe I can share some housekeeping items, as we let people settle in. So tonight we do have Michael and Gianna from OneAZ Credit Union who will be presenting on borrowing. But before doing so, I will go over these housekeeping items just to ensure that our event goes as smoothly as possible. Well, first, we would like you to take a moment to check how your name appears. If you are a participant here tonight that is here for extra credit, or if you are a scholarship recipient wanting to complete your financial literacy requirements, please make sure that your full name is displayed on the screen. That way we can make note that you were here tonight. If you do want to update your name, you're more than welcome to do so now. If you're not sure how to do so, all you have to do is look down on the Zoom toolbar and select the participant list, and then just hover over your name and select the rename option. So we do want to inform you that tonight's presentation is being recorded for educational and promotional purposes. So this recording will actually be available on the FIE's YouTube page in case you need to reference back on what you have learned tonight, or if you want to share with a loved one. Now, if you do not wish to be recorded, you're more than welcome to keep your camera off, and there will be many other opportunities for you to participate and engage. We also want to let you know that captions are being provided this evening, so you can share those services through your Zoom toolbar as well. We do ask everyone to please keep your microphones muted so that we can easily hear our presenters tonight. And if you do have any questions, we do have Juanita monitoring the chat. So just make sure to enter your question on the chat, and we have already set time aside so that we can go over those after tonight's presentation. And most importantly, we want this presentation tonight to be a positive and safe experience for everyone. So please keep all conversations respectful, civil, and clean. And additionally, there is a feedback survey that we kindly ask you to complete towards the end of this event. And by completing this survey, we can better track attendance, and it is also one of the ways that you can be entered into our prize opportunities. So since we are talking about prices, I do want to take the time to let you know that there are several ways for you to win prizes throughout tonight's event. The first way is by following us on social media. If you wish to be considered, please follow the First Year Experience program on Instagram and X. Also, make sure to follow the Office of Financial Aid and Scholarships on Instagram. The handles are displayed on the screen, and they are also being shared on the chat. 2 lucky winners will be selected and will receive a bundle of swag items from Pima Community College and OneAZ Credit Union. We will announce the winners towards the end of the event, so please make sure to follow us. The other way to win a prize is by completing our feedback survey. Anyone that attends both Spring Money Matters events and completes a feedback survey will be entered into a drawing to win a $300 tuition award that you can use at Pima Community College. The award can be applied for the upcoming summer or fall semester. So please make sure that you're following us on social media and completing those feedback surveys. Now, these events do take a village, and I just want to take this moment to let you know who we are. This is our dedicated team. We have Renee, who is the program coordinator for the First Year Experience program at Pima Community College. And then we have our Pima Scholarship and Outreach team. We have Anna, Carla, Juanita, who again is going to be monitoring the chat. And you have me, Simara. It's a pleasure to meet you all. And again, thank you so much for being here tonight. And from our wonderful OneAZ team, we have Gianna and Michael, who are the experts presenting this evening. Well, with that said, I will turn it over to them so that we can get started with tonight's event. Thank you.
Alrighty. Thank you, Simona, for the introduction. And again, welcome everybody. Thank you for joining us today. We are going to be going over the basics of borrowing. We did want to let you know that during the presentation, we have placed some questions in here that we would just like you to think about, right? Some of the things that, you probably do ask yourself that we might be covering today. So without further ado, we do want to start covering the basics of borrowing. So today, like we said, we want to make sure that we go over the basics of credit. You have a good understanding of how things work. We are going to be covering different loan types: credit cards, personal loans, auto loans, mortgage loans. Some tips to give you for paying off debt and borrowing wisely. And as Simona had mentioned, that we will be having a Q&A once we finish the presentation up. So some of our learning objectives, what we want you to do is we want you to be able to know how to build your credit and maintain or improve your credit score. We also want you to understand how credit works, credit card works, personal loans, autos, and mortgage loans work. We also want you to know your options for paying off debt and understanding good borrowing practices. These are all essential to you having the credit score that you want later on in life. So we're going to be getting into the basics of credit now. Again, credit nowadays is used for just about everything, whether it's, getting your first apartment, or, applying for a credit card, applying for an auto loan. We're going to start going over the different scenarios of what affects what. So the best way to start off is credit lingo. You probably have heard a lot of different lingos as far as like, hey, I need an auto loan, or I want to buy a house and I want to get a mortgage. Is it secured? Is it unsecured? These are all things that we hear day to day. I know working in the bank, we use it all the time, but I do want to clarify some of it for you so you have a better understanding of what it is that is being presented to you. So first off, we have unsecured versus secured. Now, unsecured is just that. There's no security or collateral associated with it. Usually for unsecured, when you do these kind of applications or these kind of products, it means that you're approved based off of your credit score, your credit history, and income does come into play as well to see what you're qualified up to. These ones usually have a higher percent interest rate because there's no security, there's no collateral that could then be taken if payment wasn't made, if worse comes to worse. But usually you're going to see a higher interest rate on these. Secured loans, or just secured collateral, is just that. You have collateral to be able to touch or go and get, right? So auto loans are a perfect example of a secured loan. The security of that loan is that vehicle that you're looking at. So whether it's, a brand new Mercedes or you got a brand new Ford, whatever vehicle it is that you have, that's the collateral part of that. Now with secured loans, you usually have a lower interest rate because of that collateral. There is something there that is tangible that if anything happens, well, somebody can come and grab that if need be. And again, these ones are usually termed out, so you kind of know what you're paying every month. So next up is we have revolving credit versus installment loan. Revolving credit is, for example, just like a credit card. We have it, we use it, we pay it, we use it again, right? It is never ending unless we decide that we are going to close that out. You always have that mentality of, okay, I'm going to use, I'll pay it, use it again, pay it, and can really be in handy when you might have some emergencies. You have kids that are going through school and you got to pay for certain things. So it's nice to have something like that open because you can always use it whenever you need to with the intent of paying back. Now, installment loans, these, for example, as I mentioned earlier, are auto loans, mortgage loans, things that have a beginning and an end date. So whenever you do these, it can last anywhere from 36 months to, for a mortgage, about 360 months, right? 30-year term. So these ones, it gives you a set payment over a set period of time that you're going to be making that same monthly payment on until you pay it off. So that's the difference between the revolving. It's always available to you. Whatever you pay back, you have available back to you. It's that constant circle. Whereas the installment is we have a beginning and we have an end. Okay. Amortization. Now, amortization is like it's the loan schedule of how it's going to be paid back. It's your view of what goes to principal, what goes to interest, how long are you making those payments, and what is the total interest that you end up paying by doing the minimum every month. So that's just the schedule that it is to where, hey, if you start here and if you only do this, you'll end up here. If you're here and you do more than that, this is what you could end up at or paying off sooner. So these are just some common terminologies that we do use and we see all the time whenever we're doing any kind of credit application. Now, according to the graph, whenever you start a loan, it always feels like we're never making a dent to it, right? I've been paying on my car for almost a year and I haven't seen any dent to it. The reason is because the start of any loan is really interest heavy. That meaning you're just going to see a lot more of that split applied to interest as well as the principal. If you have a good rate, you're still going to see a lot of it go to principal, but we're well past the 2% days. So really you're going to see a split of you're going to have quite a bit of interest on there with every payment. But as we start to progress and get to the middle of the loan, we're going to see that the interest that we're paying on that same loan has now lessened, right? And we can see that, well, more is now going to our principal balance as we're paying it off. And the good thing is the more that we do apply to principal, the less that interest graph right here will start to become. We'll end up paying less interest because of what we're applying, bringing us to the end of the loan where, as you can see, we're towards the end. We might be in our last year paying off the loan, and we can see that our $500 payment, $450 is going to principal, and we only got $50 to interest, right? That's great. But that's because of how it's set up. We know that, you spent 4 years paying it, you've paid the interest down, you're almost there. Hey, you're finishing up, right? We're almost to the finish line. But towards that end of the loan, you're going to see a lot less paid to interest. Now we're going to get into high versus low interest. Now this one is common because we do see a lot of interest rates across the board for everybody. But the first thing that we want to know is what is credit, right? Credit is our ability to pretty much pay back that debt. If we borrow it, are we able to pay that back? Do we pay it on time? Have we missed a payment? Are we late? Things of that nature all affect our credit score. Some of the things that do affect our credit scores, again, is making those payments on time or how many times we're applying for credit. We kind of want to be smart about what we're doing because, again, our credit is something that's very important. We need it every day. And we definitely want to get to where we're getting to that low interest bracket. Now, this is our credit score piece by piece. So as you can see, the little graph that we have here, this is what makes up our credit, right? So all of it have different weights to it, and we'll get into each one here and give a little bit of examples for it. But this is how our score is calculated. First off, the most weighted is our payment history. Payment history is your history of borrowing money and paying it back on time is the best way for lenders to decide how much they trust you. So again, are you making your payments on time? How long have you had this loan where you've made all of your payments on time? Did you miss any payments? What does it look like after the fact? So our payment history is really, really crucial because it does have a whole lot of weight to our score. Next up, we're going to go into amounts owed. So lenders also want to see how much debt somebody has compared to what they have available to borrow. So with the amounts owed, technically it's what balances do you have, right? Is it big balances? Is it small balances? Is it kind of a good mixture of we have some small, medium, large? And are we able to do more or are we just doing what we can, right? So this is what they'd like to see, that variety on your report of what you're able to borrow, right? We're not doing $100 or $1,000 loans every time to do what we need to. There's some mixture in there. Length of credit history. A longer credit history gives lenders a better idea of a borrower's behavior with borrowing money. So if you're just starting out, that's not to say that your score can't get to where you're in the 800s. It happens. It's just a matter of taking care of it. But if you're just starting out now, whereas if you started 10 years ago, the person who started 10 years ago more than likely has a longer length of history because they started sooner. Okay. If we're starting recently, well, we got some work to do before we can get to, having an average history of 2 years, 3 years, 8 years, to where anything we do in that time doesn't affect us as much. Credit mix. If a lender can see the borrower is able to manage a mortgage, a student loan, a credit card, then this makes this borrower less of a risk to them. Reason being is, again, if you're able to handle more, right? Credit is our ability to pay back debt. So if you're able to handle different types of credit, the less likely you're going to be a risk to them because they know you're able to handle that. They can see that whenever you're applying for a loan, they can see your credit report and say, hey, they have a mortgage, they have 2 credit cards. They also have an auto loan and a side-by-side. They look pretty responsible. Have they been making their payments on time? So that credit mix also helps. Granted, it's not as weighted, but it does help with the decision of getting a loan in the future. And then new credit. New credit is kind of tough because it can both increase and decrease your overall score. It is depending on what you're doing. So a lot of the times whenever we get a new loan, we'll see our score dip down, right? It's part of the inquiry process. It's part of your credits now settling with the new loan, averaging out your total length of credit history. But then you usually see it bounce right back up, right? That's because of everything that we have on a report will help counteract the new credit that we do obtain. Now, we do need new credit at one point or another, so it's not a bad thing. But again, sometimes it can decrease first before it does increase, and other times it might increase before it ever decreases. We usually see this with opening a new credit card and not using it, because now that increases your overall line. But this is what makes up our credit score. So again, one of the questions that we mentioned that we want you to think about, how many types of credit are there? Again, we're going to get a little bit more into the basics of credit. These are going to be more specific now, so we're going to go ahead and get started here. So for example, we're going to start off with credit cards, right? I know I use mine more often than I would like to, but we've all been in a position where we've had to use our credit card for one reason or another, right? But the way that that works is when we do swipe our card, the bank or whatever institution you have that card with pays that merchant. So it's pretty much a promise to pay. The bank is paying it for you, but then as the consumer, we have to then pay the card, which is the bank, plus the interest that's on there. So with credit cards, they usually have a variable rate, which again could change up or down depending on where the market is. But if it does cycle through, then we're having to pay the interest on whatever does cycle. So that's why we're paying the bank, whatever we put on there, plus the interest that might have accrued on there as well. And I'm sure you guys have heard everything under the sun about credit cards, the myths, misconceptions, they're the best thing in the world or they're the worst thing in the world, and everywhere in between. But we did want to clarify some of those things with you because, again, it's really important that you understand the differences, okay? So first one is applying for a new credit card hurts your credit score. As we mentioned in the previous slides before, it can, but it can also benefit your score. If you open it to do a balance transfer and you don't plan on using any of the other cards you had before, well, now you've increased your total credit line across your accounts, making your usage across the board a lot less. Creditors like to see you using 30% or less of your overall limit, and that'll reflect positively on your credit report. So it can hurt depending on what you're doing, but it can also improve your score depending on how you plan on using it. Carrying a balance builds credit. This one, again, you can if you want. I know I've heard, with several of my members here that, I've been told to leave at least $100 on there and then let that cycle. You can, and that shows that you have activity on the card. But at the same time, whatever balance you carry over, you're looking at paying interest on top of that. There's nothing that says that you cannot use your card, get a balance on there, and pay it off in full. Again, when you pay it back down to zero, you're not having to worry about carrying interest. And that's the big thing as far as that misconception is. It doesn't really, help or hurt any. It's just a matter of keeping that utilization low. And then canceling unused credit cards help your credit. In all honesty, I've seen this hurt more than it help, because if you've had a card for 20 years and you don't want to use it anymore, but you have a card that you really like that you've only had for 3 years, well, if you close out that card that had 20 years history, you're going to lose 20 years of history from that one card from closing it. So you really want to take a look at the cards that you do need or don't need, as well as how long you've kept them open, because if you cancel one out that's been a trooper for you the whole time, you might want to reconsider, because it can drop your points on your credit score significantly. These are some of the ways that we would like to talk to you about how to safely get a credit card. I know we see all kinds of advertisements everywhere. Credit Karma, Experian, going down the street. We have friends that have this card and that card. There's things that you do want to consider before you do pull the trigger on that. First thing that we would want to consider is our annual percentage rate. There's a whole lot of promotions that go on that banks do to try and entice you to get a card, right? 0% interest for 18 months. Oh, that sounds great. I can do whatever I want in 18 months and pay that off. Well, more often than not, something comes up and then we're having to pay that new interest rate after the 18 months, which can be anywhere from, 24% up to 32%, depending on who you have and what rates they're offering. So it's always beneficial to look at the APR after whatever promotional period you're a part of. You also want to look at the fees. Are there any annual fees for just having the card? Are there any balance transfer fees to move funds from one credit card to another to pay at a lower interest rate? They usually charge a percentage to just move it over, and now you have to pay that on top of it. Credit limits. What is your credit limit if you do apply? Does it make sense for you to have that much limit or that little of limit? Is it going to be something that you are going to use, or is it going to be something that you might use too much? So these are all things that we do want you to kind of consider, sit down, talk it over. The best rule of thumb is revisit it back in about a week. And if you're still thinking about it, then you probably should do something about it, right? But if you forgot about it and you're moving on to the next thing, then, did we really need it, or was it really a want? And here's an example of how credit card billing cycles kind of work, okay? So January 1st, we got our card, we're ready to go. We don't have any balance on there. On the 10th, decide, you know what? I'm going to make a purchase. I end up spending $1,000 on my credit card. So January 31st, end of the month, the end of my billing statement is received. So I've had this card now for a full month. Now my outstanding balance is at about $1,000. Now, come February, my balance is still $1,000. Nothing's changed. Well, on the 7th, I made another purchase. I went out of town. So now I have a balance of $1,500. My due date come February 26th is due. So I make a payment of $1,000 to take care of the balance I had in January. And that leaves me with what I used in February, the $500. Now, February 28th, my billing cycle is ended, so I've received my statements. And we do have the asterisk there because since I'm carrying a balance over, we're not utilizing interest right now, but it will add interest carrying over into that next month because I'm carrying that over. Okay. And again, interest will accrue depending on where your rate is at. So now we're in March. I still have $500 left over that I still need to pay. Okay. On the 24th, I make my payment of $500. Now I don't have any balance at all. I don't owe anything. Because I don't owe anything by the time it gets to that next billing cycle, I won't have any interest on there. So now if I don't use my card, it's not going to affect me in any way, or I'm not going to have any interest that's added on to that $0. So March 31st, I get my statement and all is well. Now with credit cards, the term grace period is really the time from your statement to the next time it's due is the period of time where you can make whatever payment you want to it interest free, right? It's going to go directly to the principal. It's not going to take any interest out of your payment. It's going directly to your principal balance. So in the example, if we had $1,500 that we owed at this point, I have from February 28th till March 24th to make as much of a dent in that balance before it carries over into the next one. Or pay it in full. So again, you're usually going to see a grace period of about 21 to about 26 days or so to do so. Okay. Along with credit cards and everything else, we're going to go over minimum payment versus balance due and what the difference is between the two of them. So the minimum payment is the minimum payment that's required to move on to the next month, right? Usually you can see anywhere from like $25, $35, somewhere it really small, right? Um, Paying that minimum, you're going to see that it's going to take a lot longer to pay off a certain debt because you're not doing anything extra to that principal balance. And if interest is accrued, well, you're fighting that interest along the way as well. Balance due is just that. If I have a balance of $500 and I'm into that next month, my minimum might be $35, but my balance due would be the $500. The $500 is the balance that I have to pay that card back down to zero. And this is a good little rule of thumb to kind of see where your minimum payment will be depending on the balance you have. Most lenders and institutions will use 2% of what your balance is as that minimum payment. So for example, if we have a $1,500 balance, we calculate that times 2%. That means that our minimum payment is going to be about $30 a month, and we'll adjust to that balance as we pay it down. You got to ask yourself too, are you sure you want to pay the minimum? Sometimes, some months, it makes sense, and that we got to do what we've got to do. But if we are in the position to do a little bit more, there's a whole lot of benefits that come with paying a little extra on top of what that minimum is. So for example, here we have a credit card that has a balance of $5,000 on it. My APR is 19.99%. So if I did 2% of 5,000, that means that my minimum payment is going to be $100. Again, it's a lot higher than a $30 payment because our balance is much higher. So without the rate involved, I did a little bit of the math. It would take us, by doing the minimum of $100 a month, to pay that off in 50 months, right? That's 10 months shy of 5 years. Okay, that's a long time to be making a minimum payment. But with interest calculated in there, by making that minimum of $100, it's actually going to take us about 8 years and 4 months to pay off that $5,000 debt. Now, because of interest, we would have paid about almost another 5,000 just in interest alone. Okay, because we borrowed 5, but now we ended up paying 10. That's crazy, right? So that's why we want to make sure that we know what our APR is. We know when we're making the minimum, and if we're able to do more, it's only going to help us save money in the long run. And another question that we want to ask is, what are the pros and cons of credit cards? And we went over quite a bit, but what are some that you can think of? Now we're going to start getting into personal loans. So why would we choose a personal loan over a credit card? Now, personal loans can be used for just about anything, right? It's a personal loan. If I need it, I need it. Granted, as long as we qualify, then we can do what we need to do with it. But personal loans are really designated more for like unexpected large expenses, even a one-time expense where, hey, I only need this much for this amount of time because I plan on paying it back. It's just an emergency came up, right? And we're always talking, in case of an emergency, what are we going to do? This is a good way where if something sneaks up on us and we're not prepared, well, I need to do something quick. And a personal loan is a great way to kind of get that established. It's more, we know what the balance is going to be. We know what we plan on paying. That's why we want to do a personal loan instead of like a credit card where we have the accessibility, but then we're probably paying a higher interest rate on that anyways. And there are different types of personal loans. Again, we have, like I explained a little bit, a personal loan, which is just that. It's a personal loan that you can go and use for whatever you need it to be, whether it's an emergency, whether it's to repair your car, if you want to go on vacation and you don't want to use your own money. I mean, you can get a personal loan for that too, so long as you pay it back. And then we also have what's called line of credits. Line of credits are pretty much, it's like an account that you have access to that's like a credit card, but you don't get a card. it's a limit that's been set for you that, hey, based off of your credit report, your credit score, and your gross income, we can give you this. So if you ever need it, it's there. Now, lines of credit aren't really exacts. It can be used for if you need something, I'm not sure when I might need it or what this cost might be. It gives you the access to still have something available if and when you need to use it. We do like to make sure that most of our members or all of our members know that it is available to you, and it's always definitely worth looking into. Now, some things we do want to be aware of. Again, with anything credit wise, again, we want to make sure that you guys are borrowing responsibly. You guys do know what you guys are getting into when you go, out and looking for a loan. Some of the things that we really want you to be aware of is payday loans, title loans, short-term loans, where you're using your auto title as collateral. Um, this might be an old number, but when we did have this going on, interest rate at some of these places can be as high as 204% APR in Arizona alone. I can speak from experience. This has happened to me and couldn't wait to pay that thing off soon enough. But again, we want to make sure that you're aware that what you're signing up for, always read the documents that you have. Um, and again, just make sure you know what you're getting into. If you can steer clear away from these, again, we highly recommend you do so. Now, do personal loans have fees? Something we're going to be kind of exploring a little bit, but something we want to keep in mind. Auto loans. Now, most of us probably have a car that we use day to day, or are looking for a car, or like seeing them pass by. But again, vehicles getting to and from are, part of our daily lives as well. So some of the things that you need to know about a car payment is you do have principal and you do have interest. So this one would be a collateral loan, so it'd be secure because we have the vehicle. And the way that this works is you would have a set monthly payment every month until you pay it all the way off. And with every payment, you're actually going to have your payment split by principal and interest. So with every payment, you're going to have a certain portion go to your principal. The rest of it will go to interest to satisfy, again, the interest rate that you have. So again, the lower your interest rate, the more is applied to principal. The higher your interest rate, the more you're going to see going over to interest. It's going to be more of an even scale at that point, not making much of a dent. Whereas if you have the lower rate, the scale is going to be tipping in your favor. Some things to consider when you are looking at doing an auto loan or even just shopping around. Auto loans, they do have a interest that accrues daily. This is known as the per diem. So it can be anywhere from change to, I mean, whatever dollar it is. I've seen up to like 30 some dollars on interest per day on that. That interest rate wasn't very good, but it can happen. So when you make your payments on time, that means you are going to be paying the exact interest that you were contracted for when you did that auto loan. So we did a 60-month term, which is 5 years. If I do just a minimum from the time I get it to the time it closes, I would have paid that exact amount of interest. Okay. However, if I pay more than my minimum payment, that means that I'm actually going to be paying less interest over time, because as I make that overpayment will apply to my principal amount on my car. So I'll start to see more go to my principal balance, paying it off even faster. Now, if we pay late, past the due date, we have a late fee, we're end up paying more interest because of this per diem. Just because our due date is on, let's say, the 25th, let's say we make it the following month on the 5th, well, there's already 10 days that's passed by. So now I've actually, on my minimum payment, I've added another 10 days of interest, plus I have the interest that's still going to accrue on my next payment. So again, it's just very important that we try and pay on time. And if we can do more, as long as it's in our means, do a little bit more just to help out and save a little bit money in your pocket down the road. For example, we have this loan amount of $18,440 for our vehicle. My APR is 4.79 for 48 months or 4 years. My monthly payment being $422.91. So if I did an extra $25 on top of my loan, right, on top of my minimum payment, when starting out, my monthly payment, $372 of that will go to principal, and I'll have $50 go to interest. Okay. But on my very last payment, $445 will be going to principal, and then $1.90 will go to interest. So we're saving almost $800 in interest from time that we started to the time that we ended, and we're paying off that loan 5 months earlier because we're having that amount applied to the principal balance. Other things that we do want you to consider when you are purchasing an auto loan or shopping around, looking at finance, do you need a down payment? I know we hear that all the time when we go to dealerships that, a down payment is usually needed. Um, in most cases, it can help, but it's not necessarily that we do need one. But by doing a down payment, it can also help bring down the balance that you want to finance. It can actually help your interest rate depending on if it goes below a certain bracket. And again, it's the peace of mind of knowing that you have a little bit of equity in your vehicle to start out. You're not behind the 8 ball where now you owe more on the vehicle than what it's worth. Some other things to consider are gap insurance, service contracts, extended warranties. Um, all great products to have to be safe. We never know what's going to happen in our day to day, but by adding these products into the loan, again, it's adding to the overall loan as compared to what the vehicle value is worth. So again, it can help. It could put us upside down where we really don't want to be behind the 8 ball. But it's a great protection to have because if anything does happen to the vehicle, it's covered and you're not having to pay out of pocket. So again, as long as it fits your situation, by all means do so, but make sure you do your research on it beforehand. And then shopping new versus used. Obviously, newer vehicles are going to hold their value a lot longer because they're new. They're fresh off the lot. Unfortunately, as soon as we drive them off the lot, then they depreciate pretty quick. But if we're looking for something that we're wanting to finance and we know that we can get, our dollar's worth, our money's worth, new is usually the way you want to go because you can finance a lot more off of it. Used gets a little harder because one, how old is it? How many miles does it have? Has it been in an accident? It just having a used vehicle tells a story now that we all have to do our research on and make sure that again, it fits us. If everything looks good, then we're good. But usually used vehicles are going to have a higher interest rate because of that difference in value. Another question is a down payment required? Do we need to do a down payment or is it optional? Now we're going to start getting into mortgage loans. Again, we don't do mortgage loans, myself and Gianna. We do a little bit of stuff about it, but we still want to let you know kind of what you're looking for when you're shopping around, okay? So we do have some mortgage lingo, and I'm sure you guys have all heard fixed rate. Adjustable rate mortgage is something that we don't really hear too often. It's not a very common one, but it is still a mortgage product that can be done. And then we also have escrow. So fixed rate, you're going to have that rate from the time that you get it until the time that you pay it off. It won't ever change. So if you've got a 3% on your mortgage and you want to refinance, well, you're probably going to look at a higher interest rate now just because of where the market is. But if you keep it, you probably got the best rate out there at the time being. So, but fixed rate, it doesn't change. You're going to keep that the whole length through. Now, adjustable rate mortgage, it's a fixed rate to a certain point. So there's different terms that you can do. I know you can do, I think it's a 5, 7, and even a 10-year adjustable rate mortgage. But it's a fixed rate for that period of time. Once that time ends, it is then a variable rate depending on where the market is. So now it can go up or down depending on where it's at. So this is more of like a short-term kind of product to where if you plan on doing something within that time frame, but you want to make sure you have that fixed rate cushion, it's a great way to do so. Because again, once that time hits, then you can do something or you can look at, well, now I can sell the house because this is where I wanted to be anyways, or um, just a whole different options that you can do. Now, escrow is it's when the house comes out of the market that the seller does. They take it off of the market with the promise or the plan to sell the home. So when a home does go into escrow, that means it's no longer on the market. Somebody has the intention of buying it, and usually it lasts about 30 days to try and get everything done, right? Make sure that you have your inspections done, everything is up to code, everything is the way that the buyer wants it before it's sold. Uh, Sometimes you'll have members that'll put a deposit down as good faith money. Like, okay, I'm still very interested in this. If we need to go a little bit longer, I'm putting this down to hold the home from going back on the market. The financial process of buying a home. So whenever you do anything, home buying, auto loan buying, searching for credit cards, we can't stress it enough that you want to review your credit report. You want to make sure you know what's on there, what's affecting you, where your score is, before you get into anything, right? Because we want to go in confident, knowing like, hey, this is where I'm at, and we're not gonna be surprised by anything that might show up. Our next step is we want to get pre-approved and qualified for a mortgage loan. This is what I call the fun part, because once you do get approved, then you can go shopping, right? You can do your house hunting. You can go look at all the houses you want. You can, compare, see what's going to best fit you. But that's where you get to go and do the fun part. Once you find that house that you like or love, um, then the next step is to make an offer, right? You make the seller an offer, and it's up to them where they accept the offer, or they're going to kind of play around a little bit, see who else has money to offer as well. Because at that point, it's a competition. If you want somebody's home, or if you want to buy a home, you got to outbid somebody. But um, if they do accept the offer, are you doing a down payment? Are you gonna bring that total principal down to where you're financing less, making it look a little bit better for you down the road? And closing costs, again, something to always consider. Sometimes you might have a seller that's willing to pay the closing costs, and other times, you're stuck with it. But these are all things that you want to consider before, even getting into the home buying process, because you want to be ready. Now we're getting to the down payment. So this can be anywhere from 3% down to 20% down. Let's say our home price is 350,000. That would bring our down payment to anywhere from 12,250 to $70,000. So an example of this is depending on the amount that we do, right? We have a 30-year loan, our APR is 6.5%. If we did that 3% down right at the get-go, our monthly payment would be $2,766. If we did 10% down, our monthly payment would be $2,601. And then if we did 20% down, our monthly payment would be $2,248. So as we mentioned earlier, a down payment can greatly affect your picture, right? Of how you want things to be done, of where you're comfortable at, the payments that we're able to make a month, just where it all fits. So a down payment can be beneficial to you if it's a certain number that you're looking to get to. We at the credit union on our website, we do have a mortgage calculator that you're more than welcome to use. If you want to jot that down, homeloans.oneazcu.com/calculators. You're more than welcome to use it at any time. Again, it is a free resource that you can use. So what are some other mortgage options that you didn't know about that we kind of discussed? And now we're going to get to the how to borrow wisely. These are the good tips that we want to make sure that you guys understand before we leave today. So these are the do's of borrowing. Always want to raise our credit score and then borrow. The better credit score that we have, the more we're going to be able to do with it. The better our interest rates are going to be, the less of a down payment we're going to have to make. It just improves our overall situation because of where our credit score is. Fixed rate is better than a variable rate. Fixed, you're going to have that same interest rate from the time you started to the time you ended. Variable rate can change depending on where the market is. So just kind of be aware of that. Larger down payments can improve your rates and lower or even eliminate mortgage insurance. So mortgage insurance, we didn't cover. Again, we don't deal too much with it. But again, in all other aspects, it can definitely improve the rate. It can bring it down to where you have a much better picture than being upside down on a loan. Always shop around for the best rates, compare, contrast, make sure, it fits what you're doing. You might have one place that's selling it here at a higher rate, but you go here and you're getting a much better rate. Your payment's a lot lower and you're getting the term that you want. If you can pay off debt early, pay off debt early. Again, it's one of those where we don't want to be dragging something around longer than what we need to. If we can pay it off, try and pay that off because in turn, it'll help your credit score as well. And then always review your truth in lending statement. This will let you know any fees or anything like that that's associated with it, that's associated with that loan. So interest rate, monthly fees, annual fees, things of that nature. So always take a look at that whenever you're doing any kind of loan. And now we're getting into the don'ts of borrowing. Okay, not as extensive of a list, but these ones hit home. So again, we talked about no payday loans. You're going to see a much higher interest rate, and depending on where that is, whatever you do to it is most of it's going to be going to interest, and you're not going to be able to make a dent on that. No title loans. If you own a vehicle and you don't want to, put a lien against it or have somebody hold it, don't do any title loans. Keep it to yourself. There's other options out there for you that, we can help you out with as well. And don't carry a credit card balance. Again, we touched upon it. It was one of those myths. You can pay it to zero if you'd like, or if carrying a balance makes sense to you, then do that as well. But again, it's just the lower the amount that you owe, the better your usage, the better the score. All right, guys. Well, that is everything that we had as far as borrowing goes. So we do have some resources as well. If you guys want to take a look at that, it's just a little bit of ways to help pay off debt with OneAZ. Okay.
Okay, thank you so much, Michael and Gianna, for your presentation this evening. Let me go ahead and share my screen really quick. All right, so before we go into the Q&A segment, we do want to share our virtual handout that gives you, just more information about what you have learned today. You can find the slide decks here and just more resources, our pages where you can follow us. And again, the recording will be available on our YouTube page in the first year experience. Obviously, we're going to edit it, make some edits and upload it. So just wait maybe maybe 2 days for it to be displayed at our FYE YouTube page. So I think we can now go into our questions and answers. So first question for Michael and Gianna. The first question is, if my card was stolen and I stopped it and then replaced it for me, would this affect my credit score?
If it's a credit card, it doesn't affect your credit score. So if it was lost, what usually happens is by closing it down, it's just being replaced. So you don't have to worry about your credit being affected. The thing that could affect you is if, let's say, somebody did get a hold of your card and went in and started using it for transactions. Well, those charges aren't yours and you want to dispute them, but it could still report to the credit bureaus if it's not caught in time. That's when it would affect your score because there was a change in balance on there. So, but by losing it, it doesn't affect you in any way. Again, get into your institution to make sure that you can get a replacement as soon as possible and they close out that other card for you.
Thank you so much, Michael. The next question is, do personal loans have fees, and why do people usually take out personal loans?
Go ahead, G, if you want to take this one.
So depending on where you get your personal loan, there might be fees. I know with OneAZ, the only fee we would have is a late fee after a 10-day grace period. So just depending on, like I said, where you go, they may have fees, same as credit cards. Some credit cards do have a yearly fee. One thing to keep an eye out for might say 0% interest, but then it might have a $150 annual fee. So I don't remember the second part of that question.
It was, why do people usually take out personal loans for?
Yeah, so one reason why a person might take out a personal loan instead of doing like a credit card is maybe they want the cash. So with a credit card, you have a physical card and you also have to wait for the card to come in the mail. With a personal loan, if everything goes smoothly with the process, you can get it all done in a day and even have the cash available today. You can usually the money will get transferred to your account directly, and then you can get the cash out. So, and then with a line of credit, same thing. They would probably want it because of cash. The difference, like Mike already mentioned, the line of credit is revolving like a credit card. And then if you just want a regular personal loan, it's a fixed amount and you have a fixed payment. So you know what your payment is until you pay it off.
Thank you so much, Gianna. So the next question is, does paying off the full balance on a credit card before the interest can accrue help your score? Or do you want some interest to accrue before fully paying it off?
This this is a good question because we kind of touched upon it. Um, it is totally optional to you. If you want to carry a balance to show that interest, like the usage, right? It comes with, hey, I'm using it. I want it to report. Um, but what it really comes down to when it comes to credit cards and revolving lines is where is your balance compared to your overall limit? So if you have a $10,000 limit, and if I use less than $3,000, right? If I have a balance less than $3,000, that means I am less than 30% of my usage on that card. My credit score should still trend up because I'm below that threshold. Now, same thing. If I have a $10,000 credit line and I have $200, well, my usage is going to look a lot better because I owe a lot less on there. Again, helping boost my score a lot higher because I'm using it, but not very often. Again, credit cards and things of that nature, are used for emergencies. They're used for, here and there things. But the main thing with credit cards and building your score is keeping those balances low, below that 30% line.
Thank you, Michael. Next question, how do you get a fixed rate on loans and credit cards?
So certain loans have fixed rates and certain loans do not. One thing that does have a fixed rate would be an auto loan, for example, or a personal loan. Usually revolving accounts do not have fixed rates. They're going to depend on what the market is. So you may notice if you have a credit card that you've had for 10 years, you don't have that amazing rate that you used to have. It might be a little bit higher now. So usually, a good rule of thumb would be anything revolving would have a variable rate depending on the market. And usually, those loans, like an auto loan or anything that has the fixed payment, does have that fixed rate.
And to touch a little bit on as far as like a secure credit card, we did mention that it's collateral based, right? So in order to get a secure or a fixed rate on a credit card, you're looking at doing a secure credit card, which is you putting your own money towards it to get that limit for yourself. So for example, if you wanted a $5,000 limit, but you wanted that rate, to be a little bit fixed, well, then you're going to want to put that on there. So that's like our secured loans that we have. It's the security of it. Whenever you have the security against that collateral, you're going to have that lower rate and that fixed rate.
Thank you. Next question is, should you at least have a 30% on a credit card, or is that bad?
The 30%, like I said, it's a good guideline. We have some people that they swear by the 20% mark, right? Or even 10%. 30% is where you will start to see the score start to plateau if you start to use over that. Because then you're getting a lot closer to 50%, and then 50% can turn into 60, and so on and so forth. So by keeping it at 30, you're still a lot closer down to the bottom than you are kind of going over that hump of, well, now I'm at 50% usage. I've used half my limit. What am I doing? How am I paying that back, right? So again, it is a myth. It is what you're comfortable with, but that's usually where we see that line as far as your credit score increasing start to plateau a little bit.
Thank you. Next question is, do you have a specific calculator for car loans?
Oh, Mike, do you know if we have one on the website? I'm not quite sure. I know of some, but I don't know if we have one specifically.
Yeah, there's a whole lot out there. I do believe that we have a couple calculators that are within the website. So again, it's kind of looking around. We'll keep it in mind to maybe post that in the next time we're doing borrowing, or at least include it as well. But I mean, you can always call, ask around, always look at your rates. But you can search up just about anything to find a calculator that you need online nowadays. So just make sure that it all matches up, you're entering the correct information, and you should be good to go.
Thank you. And one last question. If I'm thinking to refinance my car, would that benefit me?
Do you want to go, Mike?
I'll go.
Okay.
So it can benefit you, most definitely. It just depends on how your situation looks. If you've had the vehicle for 3 years, but you had a much higher interest rate, 3 years ago than where rates are at now, most definitely it'll help you because one, your rate would drop. And because we're going to be financing at whatever balance you owe now, as opposed to when you first got it, your monthly payment is already going to decrease right off the bat, which means if your minimum payment decreases, you can now continue to make the same regular payment you are making and have all that excess apply to principal, paying it off a lot faster, paying less interest on the rest of that loan. Again, just making that situation look a lot better. But again, it all depends on, what's the year, make, and model of the vehicle, how many miles does it have on it. If it looks good and if it makes sense, then a refinance is always something that we recommend looking at because it could totally change the picture, totally change it.
All right. Well, thank you so much, Michael and Gianna. We really appreciate your expertise. So now we are going to present our two lucky prize winners. Those that follow us on social media accounts were entered into a drawing, and our lucky winners are Saraya Shine and Isabella Fox. So congratulations to both of you. You have won the prize bundle that you see on the screen. We will send your prize package to the mailing address that is listed on your Pima profile. So please allow us a few weeks so that we can package the prize and then we can send them by mail. Again, thank you so much for following us on social media and congratulations. Now, if you're feeling lucky, don't forget to complete that feedback survey to be considered for a chance to win a $300 tuition award that you can use at Pima Community College for the upcoming summer semester or the fall semester. Remember, you must attend both Money Matters events to be eligible. Our next Money Matters event will be on April 17, and it will be focused on credit scores. You can RSVP by clicking on the link that we have shared on the chat. And we also want to encourage you to explore our partner's OneAZ Credit Union page for more information and opportunities. OneAZ is offering a $200 new member bonus. You can simply scan the QR code on the screen, use the promo code CHK266, and follow the instructions on their website to claim this special offer. The link will also be shared in the chat. Well, this concludes our presentation. Again, a huge thank you to you, Michael and Gianna, our partners from OneAZ Credit Union, and also our partners from the Office of Financial Aid and Scholarships and first year experience at Pima Community College. Thank you for making this event possible. And a big thank you to you all that are participating in this event. Thank you for attending. And if you do want to follow up with us, our information is being shared on the screen. Otherwise, I hope you all have a great night and hope to see you at our next Money Matters series. Thank you.
Simada. One of the participants said that they got kicked off, and if you could go back to the QR code, I think for
Yes.
the OneAZ prize, please.
Yes, of course.
And if you're not waiting for the code, you guys can definitely jump off. That concludes our event. Thank you.